Welcome back. You're with us here on Editors Roundtable. Tough week. Worst we've had all of 2024 so far, with a 4% cut Friday to Friday, and that too with the holiday thrown in. So one can only hope the next one perhaps is a little better. But we are, of course, discussing what was top of mind, and what will be top of mind will be earnings season, and IT will be off the block. First, TCS reports on Thursday. Reema, are we expecting any recovery, or is it going to be a little subdued?
Well, no recovery. So Q2 growth rate should be similar to what we had in Q1, or maybe slightly better, because US banking and financial sector continues to recover. Margins will be largely stable. Management commentary to remain unchanged from Q1, which means they will still indicate the discretionary spending has not come back. It continues to remain cost optimization and large cost takeouts. But you have to keep the context of where IT is in mind. Now, in the June quarter, the Nifty IT index rallied 16%. From 1st of June to now, the Nifty IT index is up 30%, and at the same time, the Nifty is up close to about 15-16%. So massive outperformance, and valuations too are rich compared to what they've been in the last 5 years. But that said, even the market itself is trading at valuations higher. Most of the sectors are. So, now I think what analysts are saying is that, the narrative is that growth is going to recover. We've seen a valuation re-rating. Investor positioning, which was deeply underweight, perhaps has now become neutral, but now numbers need to follow, or at least the commentary, the guidance needs to show that there is a recovery underway. So now the key to track will be Infosys guidance for the full year. Now it currently stands at 3 to 4%. The question is, will they go ahead and up the guidance? Many on the street believe there is a case, given the kind of deal wins, the ramp up. So Kotak is talking about a guidance increase of 100 basis points, 4 to 5%. Citi is talking about an increase in guidance. CLSA maintains that Infi will hold on to its guidance, but they say if they don't, it would be a negative trigger for the market. Secondly, the street expects that in FY26 there will be margin expansion, but so far that margin expansion hasn't played out. So commentary regarding whether this thesis of margin expansion holds for next year is going to be watched, and whether revenue is going to accelerate. I'm going to quickly leave you with some brokerage opinions. So CLSA says they remain cautious on the Indian IT sector. The lack of large deal ramp up and rich valuations keeps them cautious. Nomura is constructive in the sector because they're talking about revenue accelerating, revenue earnings bottoming out. Kotak says there will be an improvement, but well short of the normal. And HSBC is saying that we are heading towards a prolonged period of consolidation and range-bound returns for the sector. This is similar to 2014 and 2018, when the IT index offered mid-single-digit kind of returns. So we are in a painfully slow recovery in progress. So, Aman, where do you stand on IT? I think in the last conversation you said that you're neutral on IT. Earnings may have bottomed out after 2 years of downgrades, but are we looking at earnings upgrades from here on?
Not in the current quarter, though we stay neutral. We haven't added much to the IT exposure that we have. Our current IT exposure would be in, say, single digit, mid to high single digit, and we're staying there. And I think it's too early for companies as well as investors to look at margin recovery in 26, because none of the companies is going to talk or guide about next year in the current earnings season. So it's mainly 3Q and 4Q is when people will, or the company will start talking about the next year, where I feel that there can be a margin recovery for a simple reason that the attrition has come off, and hence the cost pressure from the wage cycle is lower than what it used to be, say, 2 years back or 3 years back. For that reason, I believe there can be margin uptick, but that's going to be a small uptick. It's not going to be like 25 to 50 to 75 bits kind of a margin improvement, nothing substantial, but that's going to be a positive signal which the market is looking for, but mainly in the 3Q and 4Q, not in the current earnings season.
I want sticking to IT. I know you all have Oracle in your fund. Maybe you can't talk about individual names, but within the IT, your preference would be more towards mid-cap IT names, and there you expect the growth to be much higher?
Definitely. Mid-cap growth is higher, but not much higher. If large cap is going at 4-5%, mid-cap is going at 6-8%. And in most of the cases in mid-cap also, the valuation is reflecting that. So today we have a Persistent or a Coforge or the Emphasis. It trades at multiple which are higher than what Infosys multiple is. And it is a reflection of the growth rate of these companies. So we need to balance it out. At one point of time, you might also feel that while the large cap, the growth rate is not that great, but the valuation is factoring in that. Currently it is not, but at a later that could be the scenario. So it's not always that always we prefer a mid cap, but at the current juncture, yes, mid cap makes more sense than large cap just because the growth rates are much better there, right?
You know, we have the RBI monetary policy also ahead of us, Aman, and that I think becomes interesting because we've got a big signal from the Fed with a large deep cut. Do you think for equity markets, maybe they'll watch this one a little more closely than usual, and would it matter?
It will matter on the fringe, but not much because anyway the rate cut expectation in India is not very high because we never saw that cycle which US saw where the rate from 0 went to 4+. So from that perspective, yeah, we are looking for marginal rate cuts in India to come in, and that's not going maybe 1-2 days of sentimental impact on the market, but nothing major as far as the equity markets are concerned.
Okay, thank you very much, Aman, for joining in. Next week is going to be crucial with the RBI policy and the start of the earnings season. It's been a tough week. Everyone, rest, rejuvenate, and prep for the coming week. Keep it with CNBC TV 18. We're going to wrap on Editors Roundtable. Thank you for watching.